nada, bienvenidos a este escenario. Como decía, ya tenéis ahí las pantallas preparadas. Deseando escucharos, todo vuestro. Muchísimas gracias, chicos.
Muy bien. Muchas gracias. Bueno, buenos días a todos. La verdad es que hemos tenido mucha suerte, hemos sido agraciados con el espacio justo después del café. Y nada, pues igual que otros compañeros, la verdad es que es un verdadero placer estar en una ciudad como esta, como Cáceres, un foro como vosotros, ¿no? que es una maravilla. Y además nos sentimos muy afortunados de poder hablar del reaseguro, ¿no? Que aparte de que es algo que nos dedica a nuestro día a día, nos apasiona, pues es algo recurrente en la agenda de estas jornadas, ¿no? Lo cual pues nos llena de orgullo, ¿no? Me vais a perdonar aquí, voy a cambiar a inglés porque tenemos un compañero que viene de Dublín. So I was just saying that we are very privileged, very honored to be here. And likewise, I'm very grateful to be here with you. I'm with a very good company, with friends, with partners. These guys, they've been supporting us and Mapfre Global Risk as well for many, many years. So before we start, thank you very much for your time and for being here with me. Okay, so I think that in the last seminar that we have back 2 years ago in Malaga, the first question that was raised when this panel of insurance kicked off was about the state of the market. This was 2 years ago. I remember one of my colleagues, Miguel, he's actually my boss, he was talking a little bit about how the status of the market was. He was talking about the tipping point that we were in terms of pricing. They reflected a little bit on the past, on all the losses and all the capital pressure that we have putting us in that situation. And now 2 years later, we are still very much talking about this. It's a very current topic, with the difference that we are not at the tipping point. We're probably going downhill a little bit. And also reflecting on José Luis Jiménez's presentation, which was excellent, by the way, I was looking at that environment whereby there is a lot of uncertainty, and still the stock markets, they were like very positive, very optimistic. And when I was looking at that, I thought a little bit about us in the current cycle, which is not exactly the same, but it has some similarities. We are making good money because we didn't have much losses. But at the same time, we see that uncertainty as well, but we are not that positive because we see some gray areas in the tunnel. So my first question to you will be exactly about this, about the current environment. How do you see the situation where we are now 2 years ago? We saw that we were very high back in Malaga. Now we are here in Cáceres, and we are struggling with the pricing. There is a lot of competition from you guys, as you know, a lot of capital. So how do you see the industry navigating this? I think, Tim, if you don't mind.
Yeah, thank you very much, Jose, and thank you very much for inviting me to this forum today. I was also reflecting when I saw the first couple of presentations on what does it mean for us and where's the market. I think we have had a couple of years where we actually were benefiting from a general tendency where people were really observing the risk as it's there, it's imminent. Now we've had 2 years where we had a benign, let's say, claims scenario. It was there were some actually extraordinary claims, and if you look at this in the history, we were passing the last 5 years, the $100 billion mark quite easily. But however, this has converted more or less in the, let's say, the expectation and not something extraordinary anymore. So when we are actually looking at something extraordinary, we are looking at events that are beyond the 100 billion mark. So that was the last 2 years. Before we came out of a scenario where we had more than 10 years of soft market, we were entering the hard market. We were basically looking at a scenario where suddenly risk became very apparent. Now we come kind of accustomed to the situation. So what does it mean for us? We have to be strategically intelligent in how we deploy our capacity. That is not that we basically go in and out of one client, but we have to make sure that we're actually there for the long run. So we have to deliver a return that is sufficient to satisfy our shareholders and to create a value added for the shares as well. And the current market environment is still very good. I think we're still at a level where we can support our clients, but we have to be more selective. So in terms of growth, our company, we have said, look, be very selective. Don't go for broad growth as we had done in the last 2 years, and just select the projects that are really profitable in the long run as well. So this is our philosophy. We're a very technical company. We're an underwriting company. We're a risk taker. We keep the risk. And for this reason, for us, it's important to be very diversified, so to play the diversification game, and to make sure in this scenario that we capture let's say, the slice of the market that is attractive, and that we support our clients, especially strategic clients like Mapfre, who have been with us for many years, for decades, that we really reserve for them the capacity needed. And that also enables us to work as a leader. And as a leader, we work together with our clients. We make sure that we pay what we owe, that we pay it in time or even faster. Just a short, let's say, advertisement here. Last year, when we paid out the first claims regarding Melissa, the hurricane, it was within 7 days.
Wow.
So, and I think we stick to that philosophy. And with that philosophy, I thought that's very compatible to the philosophy of Mapfre Global Risk. I think it has worked quite well. And we will navigate the soft market as well, going forward.
Okay, very good, very interesting. I'm happy to see that you have Mapfre as one of your, selected clients for growth, and likewise, Minigre is one of our main partners. And as you said, we look forward to navigating the cycle together. Brian, you come from a little bit different perspective. Brian is also a leading underwriter from a different company, maybe a different profile, so maybe you can add some brush strokes around what he said.
Sure.
So what's your opinion on this topic?
Sure. Thank you for having me, and thank you for allowing me to speak in English. Yeah, I agree with Tim. As we enter into a more competitive market, it's something that we embrace. We spend the vast majority of our careers in competitive markets as opposed to extremely hard or weak. And it's our goal as a reinsurer, to echo Tim's comments, to achieve adequacy or cover the cost of capital across the cycle. We do that, we protect our shareholders, we build strong balance sheets so that we're ultimately there to pay the claim for Mapfre Re. At the same time, our shareholders are constantly seeking healthy growth. So to achieve healthy growth, you have to be competitive. And our goal as underwriters is to balance the two. So achieve adequacy and at the same time be competitive. And to be competitive, we need to be efficient. We need to pass that efficiency back to our clients and ultimately back to risk managers. As we enter a more competitive cycle, price to us is probably the last and the most easiest topic to talk about. We're really focused on understanding your data, understanding how it's evolved, thinking through then how we think about that from a structure perspective, something which as a market in areas we lost track of in the last soft market, and from there then wording up the agreement. Then it's a question of price. So the art for us is constantly striving for that balance of adequacy and at the same time being competitive, and that's why we love being in this business.
Very good. Yeah, I think balance, juggling different balls, this is something that we are going to discuss quite a lot. Pablo, you are on another side. Pablo is leading the FAC operation of Gallagher. So you probably have maybe a little bit different perspective, but I'm sure very insightful as well.
Thanks for having me here. It's a true privilege. For me, I'm a Spaniard, so for me being in a forum in Spain is a very fortunate thing. By building on what Brian and Tim were explaining, I agree. The market is not static. We are used to cycles, and I think soft markets have dynamics will represent an opportunity for the market as a whole. I think the entire participants of the market in a soft market, while they all try to remain very disciplined on the capital cost and obviously the underwriting and the adequacy, there is a pattern on the soft market which drives innovation, new product. Obviously, reinsurance is purchased in a different manner. The hard market pattern, the original insurers and the ceding companies as a result have been retaining a lot of exposures, they have been transferring less risk, and now we are in a soft market in which the dynamics are reversing. And then you normally see two things: a lot of product innovation. People need to diversify because the adequacy rate is pushing, and you need to have a more diversified portfolio and also to continue growing, which every company needs from a geographical perspective and from a product perspective. So I see soft markets as a great opportunity for innovation. But obviously the differentiator of a soft market, in my view as an intermediary, is that it is truly an opportunity to review how capital is structured and allocated, and as a result, how reinsurance is transacted and purchased. And lastly, at the end of the day, we as intermediaries in a soft market and in any market, what we are trying is focused on the client to drive the best possible outcomes from the clients. The right risks in the right layer, with the right counterparties, capacity allocation, advising on the go-to-market strategy and the specific execution of the risk transfer. I think that's what I would summarize as a key aspects of the soft market from the intermediary perspective.
Very good. So what I get from listening to you basically is that this soft market is a territory where we are familiar. It's nothing new to us. We are very used to dealing with this. Perhaps this is a little bit more challenging and more complex. And I think we all agree that discipline still matters. We have to returns have to be worked through the cycle. And just pricing alone is not enough. We need something else, as you all have been highlighting at some point. No? So the question to me really of the challenge is rather than be competing in a softer phase, especially among us, reinsurers just competing for the same piece of business, the challenge really is to stay relevant for clients, as you mentioned, no? and to keep adding value through the cycle, whilst at the same time, as you mentioned, creating that balance and being resilient, because at the end of the day, also we need to provide a decent return to our shareholders. No? So it's balancing that up between being relevant to the client, but at the same time being relevant to your capital providers and your shareholders. Excellent. So I think we can move on to the next question, which is again very, very, very current. And it's on the geopolitical situation and all this social instability that we have. Again, we saw a presentation this morning, and it's very much connected to our industry. No? So again, we are used to dealing with risk. It seems that the situation is getting riskier and riskier every day. So I would like to know your opinion about this. So Brian, please, if you can share your opinion.
Sure. So I joined the market 25 years ago. And at the time, it was in the wake of 9/11, and there was war in Iraq and Afghanistan. That was shortly followed by the global financial crisis, which decimated credit across the world, followed then by Arab Spring, Brexit, and the rise of populism globally, and then from there into the global pandemic or COVID. And then shortly after that, Russia, Ukraine. And as Eduardo highlighted this morning, 25 and 26 have been tumultuous and tragic in areas across the globe. So as a panel, as we talked about preparing for today, the macro or the global geopolitical scenario, it's been ever present in our business. And what I'm really proud about as a market practitioner is it's something that we have to keep in mind, particularly as we think about inflation and the cost of the goods that we sell. But ultimately, that macro risk doesn't paralyze us. We stay focused on the basics, and you're really thinking about the contract or the relationship that we have in front of us, working through the data, again, working through wording, and then ultimately pricing. And yeah, it's part of being on this planet that you have the macro dynamics that we have. But again, we trade forward.
Very good. Tim, I know that you like this kind of topic, so.
Yeah, I like the kind of topics, but it's a very difficult topic, and the one which basically always brings me to the conclusion that underwriting is not like mathematics only, but it's really an art. So you really have to kind of factor in all the elements that could influence, finally, let's say, the profitability of a portfolio. We'd like to have transparency about everything. That would be the perfect state, and we're working on this. We want to get the fundamentals right, we want to get the wordings right, so that in the end, we really pay what we owe, and that we don't assume any exposure that we don't like. So a couple of years ago, when cyber was, let's say, an emerging risk, it's now an established risk, we looked at this from the point where this may be covered in other policies, in other lines of business already, so we actually excluded to convert it into an affirmative cover. And you have to stay alert, but you cannot get paralyzed by it. And at the end, you also have to diversify regionally, lines of business, products, etc. And that helps to create an environment where you basically can almost budget for it, and you can be certain that this can be managed and assumed to some degree. But you shouldn't be too optimistic and say, no, that won't happen. That is not a right way of underwriting it. You have to be very deliberate when you take the underwriting decision. And this is how we approach this. Political risk we monitor for many years, and it's factored into our underwriting process. It forms part of it, but I think it's one where we as a society need to be careful, because we are coming to a point where, to some degree, we were seeing this with the financial markets. Somehow you have a lot of risk, uncertainty, but the financial markets seem to be decoupled from that. Somehow you accept that there is certain state of uncertainty, and it's just normal. And I think that's a very dangerous situation, where we could end up in a perfect storm, where we get nat cut, geopolitical, and demographic risks all impacting at the same time. And if you want so, let's say the budgetary situation of governments doesn't help in that situation. I don't have, let's say, the recipe, the answer to it, but it's, again, in this underwriting process that you need to factor this in, and that you need to be really sure what are the risks you want to, first of all, also from a, let's say, risk manager point of view, that you want to be covered and you want to lay off to the market. And then what actually can you get covered? And then if you get a cover for a certain risk, is it true that actually the counterparty will be able to fulfill this promise if it comes to, let's say, to a loss? And that's more or less my answer to that question.
Very interesting, very interesting. Yeah, and it's very curious that you mentioned some parallelism to what Brian said.
Absolutely.
About being paralyzed, about all these things. At the end of the day, we are risk takers, and this is something that we have to manage, probably with better data analytics, better market intelligence, but we have to get around it and provide some services and solutions to our clients. Paulo, you coming from a broking perspective, you probably see this from a different point of view, and there might be some opportunities that you guys might foresee in this kind of convoluted environment.
I mean, our entire business is built on value to the client, and then we always, despite understanding the challenges to price risk in an extreme situation or in a crisis, I tend to see some positive things which I think help us evolve as an industry, which are the result of crisis. 9/11 generated the standalone SRCC. Emily and Vilma transferred all the exposures from the treaty market into the facultative market for complex wind for a certain period of time. I can give hundreds of examples which result of a crisis, the market was challenged and ended up finding a solution. However, on extreme situations, geopolitical, and you cannot expect that the private ventures do satisfy because it's manageable. Private companies do have investors. They need to hit their return on equities and all of that. And that's where I find on geopolitical and other risks, which to cover that gap that we all talk about, that the solution has to come through a private and public partnership, because there are things which are basic needs of civilization, society, and economies that someone must attend. And some of the geopolitical events, war-associated events, are a clear example. So I don't think we can expect, despite Tim is always driven to help the clients, that the market does provide a solution to all the crises. No? One of the things I find extremely interesting about the geopolitical crisis and incidents is how the interdependent world in which we live in, and how basically the events are correlated, and they are basically in a correlated operational disruption. And then we see how the supply chain is connected with the contingent BI, and how the political violence generates knock-on effects, and the interdependency on all of that. And then as brokers, as usual, we are to reduce ambiguity, bring certainty, clarify. Munich Re is trying to exclude as much as possible, and we are trying to, sorry Tim, to use just an example, we are trying to agree with the market what can be covered. I think they explained it. Bring certainty, clarity, tighten the wordings, so at least, despite the limited coverage, the coverage works as is intended when designed, if that makes sense.
Excellent. Okay, so what comes through really from all these three perspectives to me is that geopolitical and social uncertainty is really, it's a constant feature of the current landscape. It is something that we can't avoid. It's there, and we just have to somehow, as you said, and I agree with you, not to be paralyzed. We have to somehow try to do the opposite, try to embrace the risk, probably with better market intelligence, more sophisticated underwriting, never losing the discipline. And also, I think that the way to navigate this kind of environment is trying to be resilient in a way that we can combine our technical expertise with the ability to transform or to translate this uncertainty into solutions for our clients. So it sounds very simple. It's not like that, we know, because they are complex risk, but I think that's the way we have to face them. It's a little bit like with cyber. No? Sometimes we are a bit scared of taking the risk, but we have to be there. We have to be there for our partners, for our clients, and we have to somehow be brave, as you was mentioned before, try to understand the risk and try to see it as an opportunity. Very good. So as this is our insurance conversation, I think we can't fail thinking about catastrophe losses. You know, that's always going to be in the topic, even though we didn't have too many or significant cat losses, at least on the reinsurance side in the past 2 years. But that can change tomorrow, as we all know. But I think it's always worth discussing about cat losses, because, you know, they can move the needle. And what we see is that even though the years have been very benign, exposures are on the rise, frequencies on the rise, the risk is more complex. We are facing inflation now to some extent. So again, this is a topic that we can miss. And Paulo, I'm going to start with you.
It's fascinating. I mean, the foundation on the industry in so many economies is coming from that exposure, which can be so brutal. And these days is even more so because it's accelerated and enhanced by climate change. But I think what we've discovered is that this is not only about the huge perils in certain places whereby we need to provide solutions for a huge vertical volatility loss. It's becoming structural. And I think that because there are a lot of non-model perils which generate a lot of losses, and they are recurring, and they have a compounding effect on any risk profile of any reinsurer, insurance company, or any company through their risk management. No? And then this is all driven by enhanced or accelerated frequency accumulation, while we all, and I think the intermediaries play a role there, we all innovating how to actually model and price risks. There are a lot of non-model perils, and we as an industry are evolving and trying to model that. Cyber is very interesting. I found the panel super interesting. CyberCube, the way cyber is priced, it has some tools to try to do that in a consistent fashion based on factual data, as the tools are in constant evolution. So I find that very interesting. It really become a structural component of any risk profile, and it's not only about the Californian quake or the Florida wind. That's the first thing I would say. We as intermediaries, we try to connect basically all our exposure modeling tools and actuarial tools at the service of the clients, including the risk managers. We try to provide an efficient market access for that capital efficiency allocation that we were discussing on the first question. And then obviously, we utilize and leverage innovative tools, the dynamic financial analysis tools, to structure the placement based on efficiency. What should be retained, what should be seeded, and where should be seeded for an optimal outcome to the clients. And then for risk managers specifically, and I know we have a lot of risk managers here, which are consumers of complex risk transfers, and that means reinsurance in the end, pues I see aggregate covers really a mechanism to manage the volatility, you know, or liquidity, parametric. There is no question the parametric triggers do bring liquidity and speed cash, and that's extremely useful to the industry. And then the non-standard distressed occupancies, that's facultative. Facultative is basically an excess and surplus is the mechanism that basically does the tailor-made, bespoke, and deliver solutions where the treaty reinsurers. So I think it plays a fundamental role on things that are very complex and require tailor-made work.
Yeah, but you're very right. This is, as you said, it's a structural part of the market. It's not an external shock anymore. It's a structural part of the system. Tim, you coming from the largest reinsurer in the world, you probably have a lot of cat exposure on your shoulders. What's your view about this?
I mean, we like cat risk in general because, especially the one that it can be modeled, and that's the foundation of our business. But I think the market has actually moved into a direction where it said, look, there's some sort of risk, which is also now called cat, secondary perils, non-modeled perils, you name it, that is actually so structural and occurring at such a frequency that you need to factor this into your, let's say, into your primary insurance pricing, and you cannot, it shouldn't be transferred to the reinsurance market because it's money swapping, more or less. And we want to kind of be at the extreme cat risk, so to say. So we want to be there for the really large scenarios. However, we've seen also that in our books, the non-model portion of the claims is rising, and that is a concern. It wasn't, let's say, the case in the last 2 years, but before that we saw that this portion is constantly rising, which meant we needed to kind of take structural, let's say, actions to bring it back into balance. The situation is, as Pablo said, is a very difficult one, and you need to kind of also look at what are solutions available, parametric solutions that can actually, let's say, help in addition to the traditional business. But we should be aware of and really not fall into the trap of now going into the frequency again. That would not be healthy for the reinsurance market, and it's also not healthy in the long run. It would be, let's say, for 1 or 2 years, potentially an easy solution for the primary market, but it would be a short fix that wouldn't fix the underlying problems. So we are actually also working on the prevention side, because this is the case, this is really helping, and I think you guys as primary insurers are doing a great job actually fostering prevention, so making sure that those national schemes that are now, let's say, being contemplated, that exist for years in Spain, for example, factor in a risk premium that really does the signaling effect that gives the buyer, the purchaser of the insurance, a clear indication whether he's in a risk zone or not in a risk zone, and what he has to do to improve his risk situation. This is actually something that's now being very prominently promoted in the European Union. And I think with those measures, we can make it manageable. But it's very important that we focus as a society on keeping the global warming at bay. So don't let it just continue as it is currently, because that would just make the events more extreme, more severe. Mm-hmm. And therefore, let's say the structure will move up and not down.
Mm-hmm. Okay. Very good, very insightful comments. I'm sure that you, Brian, being also a leading person in the industry, especially on the retrocessional side, you are very used to paying, well, to dealing with big catastrophe losses. You've also been very supportive to Mapfre when we have some of them. You've paid big bills there. So what's your opinion about this topic?
Yeah, maybe to echo the guy's comments, we need risk, be it nat cat or systemic risk like cyber, to work our balance sheets. So we're not risk adverse. We're constantly looking for that risk. And then I agree with Tim, it's about finding structures that are equitable, that drive the health of society on that risk transfer, that are important. Then specifically on nat cat and climate change, collectively as a market, we've invested heavily in that over the last 20, 25 years. Our focus today is, and I would say with that investment, we still know we're wrong. We're just less wrong than we were yesterday. But our focus as we face into 2027 and beyond is really getting a better understanding of the data that you have as risk managers that describes how you're thinking about the assets that you have, assets that you're buying, assets that you're redeveloping, or assets that you're putting to bed. And a better understanding of that data would allow us to get back to be more competitive, you would hope, and at the same time more sustainable through the cycle. So our focus, whilst I agree with the guys, it's very much on the quality of the underlying data, and then it's our job as reinsurers then to reward the data that you provide us that describes the risk with more transparency. You may not like the answer that we have, but hopefully that constant increase of transparency will move us away from the commoditization of the risk, which at times can be an issue.
Mm-hmm, mm-hmm. That's a very, very interesting perspective from my point of view, because you are totally right, and I agree with you as well. We tend to focus on pricing. We have a lot of discussions on margins and things like that. But actually, the real way to tackle this is very different. This, as you say, is probably through better data analytics, better understanding of the risk, a lot of transparency, and that ultimately will have an impact on pricing. But as I said at the beginning, I think that we are somehow collectively just focusing too much on the pricing, on the transaction, and sometimes we feel that is something much more fundamental to all of these things. No? And you clearly mentioned to them that pricing is just the final bit of a certain transaction at some point of time. But beyond that, I think we have to go much deeper and deeper in trying to understand the underlying information, enhance the data analytics, and of course, as we try to do as Mapfre collectively as well, is to be as transparent with the risk that we have, so you don't have surprises. Okay, very good. So I think we can move on to the final question, which is somehow related to the others. And again, back to the transaction, to the pricing. We sometimes feel that good partners, good reinsurers like you tend to focus more on something else rather than just the transaction. So we think that the kind of relationship that we have with our partners and our insurance and brokers, of course, as well, is that we require you to be much more strategic rather than focusing on specific transactions, on specific renewals. So what's your view about that? What's your approach about, in general, the market? And if you give us some insights on Mapfre, that would be good. Tim, you can start.
We want to be very strategic and a long-term partner with our clients, and especially with Mapfre, who's one of the biggest clients for us, and who is a very successful client as well. But we are all driven to some degree also by quarterly results, yearly results that we have to kind of publish. And the financial market is not yet, I would say, at a point where it is, let's say, valuing this the same way as we internally would like them to value it. We we want not only to be a strategic partner, but we want to be leader in a relationship. And as a leader, we have a different lever, we have a different ambition. We want to provide not only capacity, but really strategic insight, work with you on your strategic topics, make sure that you can, let's say, onboard the business as easy as possible. I think the level of sophistication that the industry has reached over the last 20 years is unprecedented. From where we've been in 2000 to where we are today, the level of granularity of data, the level of modeling is something that has evolved a lot. And I'm sure that also with AI, this will actually go even further. So what we have seen in terms of GDP growth or affluence growth around the world with globalization, with data management, will also translate into our relationships. We will have more transparency about what are you doing, how are you doing it, and then it's more about, it's not just about underwriting the portfolio, the treaty, the risk, it's underwriting the underwriter and knowing exactly, okay, this underwriter has the same philosophy or a similar philosophy to us. It's safe to go with the underwriter, we can trust it, we have the data, we have the transparency if we want to look at this. And this is the direction we are heading to, and I hope it's the right direction.
Definitely is right, and we can feel that at Mapfre as well, that you have that kind of approach with us, which is sometimes we have discussions on pricing and deals as it should be. We are both technical companies, but it's true that that's the kind of focus that we like, to be more strategic, more holistic. And I will throw the question back to you, Brian, because also we've been advancing together quite a lot in the last few years. You've been traditionally more monolithic or very focused on certain parts of the risk, Mapfre and in the market, but you've been diversifying, and with us you've been adopting a more strategic approach, which we think is good and is more tailored to our needs. So I'm very interested in your opinion.
Yeah, like reflecting on Bosco's comments this morning, we don't think the product that we're selling is a commodity. When you need us to pay the claim, it certainly won't feel like that. And to be more strategic rather than tactical, can echo Tim's comments, again, back to data, but deeper discussion on it so we really understand your view of risk and learn from that. And then from there, we think a lot about partnership on our side, particularly over the last few years. In our history, going back 25, 30 years, we were very quick to trade out of a position. And partnership for us today is about being a lot more patient, being more thoughtful as to how we think about where we are in the cycle. And I would say that we've learned a lot. So I would hope that we come across as less tactical, more strategic. But at the end of the day, at each point in the risk chain, that has to be a two-way street. And for conversations to be strategic, I guess it's not a zero-sum game. Each point on the chain needs to be able to reward their shareholders. And I would say I just sum it up with to be more strategic, be more patient on our side. Yep.
Excellent. Pablo, again, in your environment, it must be a little bit more different, but I guess that is very...
Well, it's normal. I mean, the underwriting and risk business is driven for an underwriting profit, and we are a different actor within the industry. So it's healthy that we have different perspectives, and we are all partners in the end. I think we all agree that we value long-term relationships across the entire participants. The challenge we have sometimes is how we actually make something tangible that is representative of that in practice. For very complex reasons. This is still a super fragmented market. And then it's made of buckets of blocks of capacity and balance sheets. And then to make something meaningful, not with one market, but with enough capital and capacity providers that brings long-term partnerships which are meaningful, effective solutions is a challenge, because the market in nature is a capital market and is extremely fragmented. And for very large and complex risk, or for emerging exposures or even new, we still don't have a market. We need to build it. That's one thing I think is relevant. I think the strategic partnership means find solutions to the emerging risks and invest and be entrepreneurs on it. Because if you analyze how the new innovation and new product formation came, there was always someone with courage starting underwriting something, and they lost some business along the way, and then they made a lot of business. So the strategic partnership for me isn't, we understand CAT and the CAT rates and the volatility and all of that, but I think we as an industry have a collective responsibility to find solutions within the boundaries of our profit margins and all of that, invest on the business, provide solutions on the challenges the industry has. I think when I see a strategic partnership and I am sitting in front of a client, we cannot simply transfer the plain vanilla and leave the most challenging part of the program, so, which we tend to do because we are fragmented as an industry. And then for sure it means transparency. I think clear risk narratives from risk managers, from seeing companies when buying reinsurance. This is key. Transparency, for sure. Trustful relationship based on transparency. Then have a view of a sustainable solution from a risk transfer perspective. Opportunistic, but sustainable. Why? Because I think the solutions, efficient risk transfer solutions, have to work across cycles, and you need to transition from the soft market solution into an evolved risk transfer for a hard market, if there was any at some point in time. And they have to be sustainable, opportunistic but sustainable. That also comes to my mind when I think about long-term relationship. And then consistent behaviors under stress. So I don't think clients like when there is a little bit of an issue here, and then no, we cancel all the coverage, we don't write any more coverage. So we do that as a market. So I've seen it many times. We all run away. No, there is an issue in the Middle East. Let's cancel everything. I'm not saying. And I think we collectively need to understand that there are broader components, and perhaps we need to kind of find a middle ground solution, if that makes sense. But that's what comes to my mind.
I fully agree with you, because I think we're talking about being strategic, and strategic starts with trust, and trust is backed by consistency, as you said. You cannot be trying to be at the front of the client and then run away when things get difficult. So trust needs to be backed by consistency and also by execution, because it's when difficult moments arise, or when you want to be in a strategic for the client in a need that is not so easy to cover. That's where you have to show that trust, and that goes both ways. Transparency is key. Okay, so we discussed basically four topics. We discussed a little bit about the status of the market. It was nice to bring it back from the previous Jornadas Internacionales, and not 2 years ago, how it's looking. We are in a slightly different situation. Then we discussed a little bit the geopolitical and social uncertainty that, as we said, is a common feature of our risk landscape. We touch upon cat losses. Obviously, this is something that we can never leave aside, because that's moved the needles, and that can change our market today. And we also talk about being more strategic, which is crucial in a moment like now. No? And we hope that we can be together more strategic, because in the current state of the market, we tend to focus too much on pricing, which obviously is very important, as you mentioned. We have to please our shareholders, have to please our Mapfre company as well. But I think that the future of the leadership of the insurance has to be more than rather looking at the transaction, looking at the renewal. Anyone can do that. And we don't need you guys to do that. We need you for something else. We need you to share insights, to share market intelligence, to exchange all these data analytics that we were talking about, enhance transparency, and of course, to leverage on these long-standing relationships that we have. So I think we are right on time. It's been a pleasure. Thank you very much.
Thanks.
And hopefully we can do it again. Thank you for your attention.
Thank you.